Hello friends, welcome back. In this today discussion, we are discussing about internal analysis and external analysis. If you remember, in the previous session, we talked about strategic planning process. To do the strategic planning, we have to do an internal and external analysis to see what are the opportunities we have internally and externally, and what are the threats or what are the challenges we have internally and externally. Let's start with a business case. A company which manufactures high-end residential water filtration systems. They currently sell their unit for $1,200. Their CEO Sarah is preparing the strategic plan for next 5 years. Currently, they have a 20% profit margin and a loyal customer base. However, a new federal law was just passed requiring all new homes to have pre-installed filtration, but 3 large international appliances brands have announced they have entering into the same market. So this is a business situation actually. So there is an opportunity in this situation. So that's why there is a new federal law which is expected to increase the demand of the product. But at the same time, there is a threat from the entrance of new competitors. So to see what are the opportunities and what are the threats we have to do an analysis. That analysis what we called as SWOT. That means strength, weakness, opportunities and threat. If you do this analysis, we can see and we can break down these cases into what are our business strength and what are our weaknesses, what weakness we have as a business. Then what are the upcoming opportunities we have as a business and what are the threats that we are expecting in the future. If you break down this business case into these 4 cases, in these 4 scenarios, it will help you to make a business decision process and decision making process. So before looking into market, you must look company's DNA. That is, SWOT analysis is starting point of strategic planning. The SWOT analysis is a tool used to evaluate the internal strength and weaknesses of an organization and the external opportunities and threats in its environment. So 2 things, the internal strength and weaknesses, that is internal things that's inside the company, and the external opportunities and threats, that is within the business environment, that is external factors. Just look into this case. Suppose we are doing a SWOT analysis. First we have to analyze our strength. What are the strengths we have as a company? So strength is an internal factors, that is it is within the company. Suppose you have a good patent, you have a lot of patent, you have a good brand image, that are all your internal strength. So what is the budgetary impact of this strength? It will allow you to premium pricing in the sales budget. If you are preparing the sales budget, you can do a premium pricing if you have a well-reputed brand and well-reputed company in the industry. So it will allow you to premium pricing in the budget preparation process. Let's move to weakness. Again, weakness also an internal factors. That means where you lack. Suppose you have a high employee turnover ratio, very low employee satisfaction ratio. So that means that you have to address internally. Maybe in the budgetary impact, you have to allocate some fund or some budget for training or research and development or employee retention programs. So strength and weakness both are internal factors. Now let's move to external factors. The first factor is opportunities. Opportunity means what are the positive outside trend. Example, lower taxes and this new law declared to promote our product, which will help to promote our product. So these are the positive outside trends. Then what are the budgetary impact of this? Which will drive capital expenditure budget. That means if you have an opportunity, you can do a capital expenditure budget. That means you can do new investment proposal or no investment opportunity, or you can find new investment or product development opportunities with the opportunities. Then the threat. Threat again, it's an external factors, that means negative outside trend. Example, there is a new competitors, entrance of new competitors, or any other changes in the law. These are the external factors. So what is the budgetary impact of the threat? Which may require a contingency fund or low sales target. Once you are preparing the sales budget or in the budget, you have to consider the threat in the budget. Maybe you have to consider a contingency fund, or you have to lower down your sales target based on its impact. This is a SWOT analysis. Suppose if a company mentioning in your examination, if the question mentioning the corporate culture, employee skill set, or something related to internal factors which you have to consider as a strength or weakness, that both are internal factors. Suppose it's an something mentioned the interest rate or demographic change or changes in the law, it's an external factors. You have to consider it's either it's an opportunity or it's a threat. So this is SWOT analysis, where we are considering the two internal factors, that is our strength and weakness, and two external factors, that is our opportunities and threat. Let's move into next analysis, that is PEST. PEST means political, economical, social and technological impact. PEST analysis is a strategic tool used to identify and analyze the political, economical, social and technological factors that can impact an organization long-term planning and budgeting assumptions. It's an analysis tool used to evaluate the first, what are the political factors which is going to affect the company, what are the economical factors which is going to affect the company, and what are the social factors which is going to affect in the business, and what are the technological factors which is going to affect our business. So it's a strategic tool which help you to identify how these changes in these four factors, political, economical, social and technological factors, going to affect your company. So the first factor is this political factor. Suppose a new tax policies, trade restrictions, tariff and government stabilities, these all political factors. So how you want to affect these factors in the budget? And you have to consider the tax flow when you are considering the preparing the budget. You have to consider the after tax flow, cash flow only, and you have to consider additional supply chain cost. Is there any additional tariff government implementing? These factors, the tax policies and trade restrictions, is there any trade restrictions happening in the next coming period that you have to impact in your sales? These factors has to be considered in the budget based on its nature. Then the economic factors. What are the economic factors? Interest rate, inflation, GDP growth and exchange rate. How this is going to affect your business? If the interest rate is going to increase in the coming years, you have to consider additional cost of capital, or it will affect your cost of capital. And the inflation means if there is an inflation which will affect the consumer purchasing power. Then the GDP growth. If the GDP is expecting to grow, that means all economy is growing. So there is a good chance to grow your business as well. Then the exchange rate. If you have international trade, you have to consider the impact of the exchange rate. Then let's move to social factors. Suppose demographic, lifestyle change and consumer attitude. This will directly impact your sales volume forecast and product mix based on your customer preferences or lifestyle trend and consumer attitude. You have to consider, you have to impact directly into sales and into your product mix as well. Then the technological changes. Suppose automation, research and development and rate of obsolescence. These all affecting your business directly, or in your capex or capital expenditure budget directly. Is there any key technological changes expected in the coming period? You have to implement that change in your business. So it's a capital expenditure. You have to consider that as your capital expenditure, or you have to incorporate that technological change in your capital expenditure budget. Then let's move to next analysis, that is Porter 5 forces. While SWOT is a bird's eye view, Porter 5 forces zoom in an industry's profitability. So this is analyzing an industry, not a specific business. This model explains why some industries struggle to make money while others are gold mines. This 5 force model is the analysis of is an industry analysis, not a specific business analysis. So it's explain why some industries we know like airlines, which is struggle to make the money or profit, while some others like the soft drink or some other businesses are the gold mine, or which is making very good profit. So he identified 5 forces that is going to affect a industry. So we'll start one by one. First one, threat of new entrants. This is about a barrier to entry. Suppose if an industry, if it is easy to start a new business in the industry, that industry have high threat of new entrant. So eventually that industry will become very competitive, and your profitability will slow down eventually if a specific industry have new entrance threat. Then the bargaining power of buyers. Suppose if your customers can find a cheap alternative for your product, then your customers have a big bargaining power. So the budgetary impact, you cannot easily raise the prices in your sales budget. If your customers have a big bargaining power, or they have a bargaining power, you cannot simply increase your price because of this bargaining power. This you have to consider in your planning process. Then the bargaining power of suppliers. Suppose you are using or you are depending as only few suppliers to get your key raw material, then your suppliers have key bargaining power. That means you have to consider the supplier have a key bargaining power, which means that you have to expect that your direct material cost can be higher in any time and your margin can be lower if your suppliers have good bargaining power. Then the threat of substitute. Suppose for your customer, it is easy to find a substitute product or a cheap substitute product for your instead of your product, then you have a threat of substitute. If you have a threat of substitute, that which means this has to be impacted in your sales budget. That means you cannot increase the price as you like, and there will be, you have to consider various factors while you are determining your sales forecast volume as well. Then the competitors, how the things developing with your competitors. Suppose if an industry which is operating under the companies of the one particular industry is operating in a price war situation, you have to assume that your net income will be plumped or it will be lower in future at any time, because there is a price war ongoing in the industry. Then the industry also, the price war or the relationship between the competitors in the industry also affecting the profitability of a particular industry. These are the 5 factors which is going to, as per Porter 5 force model, which is help you to analyze the industry profitability. That means the first factor is the buyers, how your customers will behave, or what is their purchasing power, or the substitute product or availability of substitute product. Then the easiness of new entrants into the industry and bargaining power of your suppliers. Then your competitive, how the competition happening in the same industry, if it is an healthy or unhealthy competition. Based on this, the industry, you can analyze an industry to see whether it is a promising industry or it's a not a promising industry. Just a quick summary what we discussed today. We started with the strategic planning, and before doing the strategic planning you have to analyze the environmental factors, the internal factors and external factors. Then the PEST analysis, political, economical, social and technological aspect you have to analyze before doing a budget preparation or a strategic planning process. Then the internal SWOT analysis, your strength, your weakness, both are your internal factors, and your opportunities and threats, both are external factors. Then the Porter's 5 model, the 5 force factors which is driving the profitability of an industry. So, a successful strategy involves aligning the internal strength. You have to align your internal strength with your external opportunity. Suppose if you do an external analysis, you can do what are the opportunities are there in the market, and with your internal analysis you can identify your opportunities what you have. A successful strategy which should align your strength with your opportunities. You have this much strength and your industry or the environment has this much opportunities, then you have to align your strength with this your opportunities. Let us look into some business cases. Suppose if a company, in the previous same example, a company is using a high-end technology in this product, suppose AI to track their water quality, and this tech company has billions in cash. As an analysis, these are external factors. That means you have a big threat from your competitors, and you have to respond it immediately while investing more into product research and development to stay relevant in the market. Let us move to next business case. The main supplier of plastic casting of Blue Steam is increased price by 15% because of the price in oil went up. That means in this case the supplier has a good the bargaining power. So this impact has to be updated in the purchase budget, or then they might need to find alternative material to maintain its same selling price or the same cost. Suppose once your supplier going to increase the material price, one thing you have to impact this hike in your budget, and the second thing, otherwise you have to find an alternative supplier with the same material for the same material. Let us move into multiple choice question practice. A management accountant for a large manufacturing firm is conducting Porter's 5 forces analysis. The accountant finds that the company's main raw material can only purchase from 3 specialized vendors globally. Additionally, the cost for the company to switch to a different raw material would require a complete $2 million investment of their machinery. These factors indicate that option A, low bargaining power of buyers, option B, high threat of substitute, option C, high bargaining power of suppliers, option D, low intensity of rivalry. Option C is the right answer here. In this case, your first thing, you are depending only very few suppliers for your key raw material. Obviously, your suppliers has a high bargaining power. The second thing, to change the material, you need an additional capex of 2 million or additional capital expenditure of $2 million. It's a big amount. In this case, your supplier has a bargaining power. Let's move to question number 2. During the strategic planning phase, the board of directors of a retail chain identifies that new government regulations will offer significant tax credit for companies that install solar panel on their warehouse. In SWOT analysis, this would classify as a option A as a strength, option B as an opportunity, option C a weakness, option D, a threat. So this is an external factor. This is a government regulation, that means it's an external factors. Again, it's an opportunity. You can see that it's an opportunity. If you install more solar panel in your facility, you can expect more tax credit. So it's an opportunity. So you have to look into your strength. What are your strengths? You have to explore this opportunity. So option B is the right answer here. So friends, this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.